You want to know what's driving this market to new all-time highs? Dow gaining 133 points today, S&P climbing 0.56%, NASDAQ pole vaulting 1.01%. It's not the Fed. It's not the trade talks. It's demand.
Buy.
Yes, demand for money.
Buy.
Demand for homes. Demand for data processing. Demand for cancer drugs. Demand for programming. Demand for fabulous cell phones. Demand for planes. And, of course, perhaps most important, demand for stocks. Yet, if you listen to most of the experts, you'll hear a lot of sound and fury about how the global economy's gotten weaker because the trade war has shut down international trade. I don't want to sugarcoat anything. The global economy has absolutely taken a hit year over year, and the tariffs are part of that. But here's the thing. Many stocks were trading like we were about to get an even more stringent round of tariffs, and that didn't happen. Instead, the president started negotiating with China, and that allowed a host of flailing stocks to get their mojo back. The trade truce just made it possible, though. Without strong demand, the averages never would have made it this far. Let me walk you through the places where that demand is most palpable so you see why I kept hitting that buy button. First, there's the demand for money. With interest rates ultra low, banks are doing brisk business, especially with the consumer. The financials started running when J.P. Morgan, Citigroup, and Bank of America kicked off this earnings season with really, truly astonishing numbers. The big takeaway from this reporting period is that domestic consumers are so strong that they've been able to offset the industrial weakness related to world trade. Given that the consumer accounts for 2/3 of the U.S. economy, the banks are in great shape, and that's how their stocks could rocket higher. No wonder LVMH, which is the big French company, wants to buy Tiffany. A flush consumer is a Tiffany shopper. No bid yet, but a stock that's up 31%, well, we're not going to miss that in Mad Money, are we? All right, it's not just the consumer. Businesses also have a voracious appetite for money. So many companies realize they can borrow at low rates and then use that money to buy back stock when the market goes down. Hardly a day goes by without a bunch of corporate debt being offered at what I think are ridiculously low rates, but appetizing to anyone who wants to earn more than treasuries. There's been more than $1 trillion worth of corporate debt issued so far this year. They're using some of that money to expand, but some of it's going to buybacks. I know it's easy to dismiss all this as the Fed propping up the stock market with cheap money, and I see it in my Twitter file all day. Guys, I know it. What do you want me to say? Our interest rates are higher than the rest of the developed worlds, okay? Compared to Europe or Japan, our money's not cheap at all.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.